Hi, this is Victor Yeung of Admiral Investment. In the upcoming episodes, we will discuss our two-step valuation framework, which calculates the net asset value, or NAV, and then calculates the fair value. Fair value represents the price that an investor is willing to pay for an entire company, or a REIT. Since a REIT unit represents a fractional ownership in the REIT, through the long term, REIT prices generally correlate with the fair value. Today we will first discuss NAV, which in its simplest form is a REIT's total asset value minus its liabilities. A REIT's assets include its real estate, cash, and other minor items. For example, if an individual investor owns a property that is valued at $10 million and an outstanding mortgage of $3 million, his NAV will be $7 million. In major cities, residential properties transact frequently, and current market price is a good indicator of property value. For properties with no recent transactions, an analyst can reference the market price of a similar property. For example, in a residential building, if a certain Unit 5A is sold for $5 million, then Unit 6A can be valued at the same price, since the two units face the same direction and are of similar height. For Unit 15A, which has a better view due to its height, the market price may be slightly higher. If we assume it to be 5% higher, then 15A is worth $5.25 million. In other words, in a market with high transaction volume, we can estimate the value of an asset by referencing recent transactions of similar assets. However, it is not always practical to value commercial property by directly referencing other transactions, since it may be difficult to find two commercial buildings with the same specifications. Instead, we value a commercial building by referencing its cap rate. Cap rate is its current yield, calculated as the net operating income expected in the next 12 months, divided by the market price of the property. Net operating income is revenue minus all direct expenses, such as property tax, insurance, utilities, and any staff costs that are directly stationed at the building. A cap rate prices in an asset's risk and return profile and can be used to reference the value of similar properties. This is why cap rates vary by property type and by city. Analysts usually keep a table of the cap rates of all covered markets, such as the one that is shown on screen right now. In addition, we often break these categories out into finer subcategories. For example, Japan office properties is typically broken out into S grade, A grade, B grade, and others, while Hong Kong office can be classified into central, other business districts, and non-business districts. Note that an analyst estimates current cap rates by keeping track of transactions. An analyst is a price taker. To value a REIT with NAV, we first calculate its real estate value. We do this by estimating the net operating income of a REIT in the coming 12 months, and then dividing this net operating income by the REIT's cap rate. Net operating income is calculated by subtracting any property level expenses from the rental revenue, and it is often a reported metric from the REITs. If a REIT owns different types of assets, we typically take a sum of parts approach. We value each type of real estate with its individual NOI and cap rates. We also add in the value of any land holdings and construction in progress. We then calculate NAV by adding to the real estate value the cash on hand and by subtracting out its financial liabilities. NAV per share is simply the NAV divided by the number of shares. NAV per share is useful because it is the cash value of a stock. If we take a REIT, sell all its assets at market price, settle all debts, and return the remaining capital to shareholders, the cash they receive should be close to NAV. In an active capital markets, share price should trade close to NAV. This is because if a REIT is trading at a substantial discount to its NAV, an investor can privatize a REIT to profit from the discount. For example, if the share price of a REIT is 1/3 of NAV, a successful privatization allows the acquirer to buy all of the REIT's assets at 1/3 of the real estate price. This is the market mechanism that, under normal circumstances, correlates the share price to NAV. Next week, we'll discuss the various situations where the NAV calculations may break down.